Shall we pause Zoom recording? Okay. Okay.
Okay.
But end of the day, like, long run fundamental analysis, like, we just get, wait, what happened? Okay. Okay. So today what I just like, try to, I mean, this is again, the disclaimer. Okay. So today what, I mean, like if you wanted to start like understanding all the technicals, it's like it's gonna take like at least a few good hours, but in this 1 hour I'll try to cover as much as I can, just to give an idea like what is investing and how to pick like some great businesses, and also like as Suresh said already, like what is the right price to buy, right? So that is what we call it as, like in Warren Buffett's terms, we call it as a fair value or intrinsic value. So I have actually put it like on spreadsheet how to calculate intrinsic value. We'll go through that, and also once we understand like the intrinsic or fair value, what is the entry point on what is the exit point is something we will understand using our dollar cost average. And I'll also share some powerful resources like some websites and the tools like intrinsic value calculator at the end of these topics. Okay, so first and foremost, like when it comes to investing, the most important thing is like the perspective. Okay, whenever we are actually trying to invest, as Warren Buffett always says, where even if he buys like like some shares in a company, if he feels like he's owning that particular company, right? So when you actually, we always call it as a stock, but once even I understand my perspective, I'm not buying a stock, but I'm actually uh, investing in a business that is profitable. So that means nothing but I'm taking some part of the share. Like even if I buy one share of Apple stock or whatever is the stock, that means I'm a shareholder. I own, like I don't completely own, but I own the part of that particular business. And we all know, like when we have a good business, either if it is our own or someone,
Just 5 minutes ready, please.
if someone is owning and we wanted to take a share, and if it's running profit, if it is profitable, again, like if we own the business, we have to actually like do a lot of hard work. But like when there are like companies that are already making money, it's just that you have to invest it and then just enjoy the profits, right? So first and foremost, when I started like investing, that's what I changed my perspective. I always like change the terminology itself. Like I'm not buying a stock, I'm buying, or I'm owning a part of the business. So that's the first and foremost perspective. When I started investing, um, I changed my perspective. So now like when I started, or when I wanted to invest in a stock or a business, like now right? So when I wanted to invest in a business, first and foremost, I just wanted to understand what is the business. It's not like we just like see randomly some big stocks and like that are going up and go ahead and invest, right? So we wanted to understand what does the business do. Okay, so as always, like Warren Buffett says, like if there are like a lot of businesses, right? Coin, fear, um, Lucid, but there are companies, first and foremost is like Apple, right? So Microsoft. When you actually go through the company, you need to be able to understand what is that company doing. So it needs to be understandable. Okay, so that's where like you get the confidence. Like even if you're like grocery business, if you wanted to invest in grocery business, you wanted to understand. Otherwise, if you don't have experience how the business works, even if you like a successful restaurant, if you own, it will end up like we run into losses, right? So it's better we understand the business, like maybe not whole a lot, but at least that is what we call it a circle of competence, like like what Warren Buffett says, right? So at least you need to be able to understand the business when you are investing in a business. So that is the first and foremost. And the second thing is like we always know that we can invest in growth stocks versus value stocks. Growth stocks, that the only difference between growth stocks is you are betting on a stock that the company is going to be profitable. They have a groundbreaking technology, and it could actually make money, a lot of money in the future, but their balance sheet or income, they're not making any money now. So but they may make money in the future. It's a great business, but that sometimes becomes a kind of a gambling, because you don't know whether the company could actually become successful or not. So you are betting on a company that has a good technology but currently not making money. So you could make millions with that investment, or you could lose everything. You can go bankrupt. But the safest investment, what I understand in the long run, is instead of investing in a growth stocks, it is better to invest in businesses that are already making money. So that way it will be easy for us to understand or to calculate the intrinsic value of a company based on the past financials they are doing. So that is the first second thing, like what I understand, when investing, this is critical. Okay. And the third thing is that they should have a strong cash position, or every company will have little or no debt, but whether they have debt or not, they should have a strong cash position, because if they have some debt, they can always, if they have cash, they can always clear the amount. But businesses always wanted to have some debt, they can, whatever they can get some on less interest, but they wanted to keep some debt, so that they can invest their cash on something. And the benefit of having the strong cash for a company is that, if you see, this year, right, 2022 is very bad. And why all the most of the businesses are the stock price is falling, is because of their balance. They don't have strong cash to support. So because of which, if their business is down, if they don't have cash, they cannot, they either go bankrupt, they have to dilute their stock, or they have to raise dilute the stock, or they have to get more money to run the business, right? So that is where, because of that reason, the stocks are going down, right? So it is always good to have a strong cash for a company when you are actually planning to invest. And last but not least, this is what is critical, that is, a company should have a moat. We'll discuss we have what is moat, and we'll understand what is the moat, and also whether it is the business has a sustainable competitive advantage, right? So we can take a few examples, I mean, I'll say, maybe we can discuss, but let's say let's go to discuss here. So when I talk about sustainable competitive advantage, there comes few things. One is brand. Now we all know Coca-Cola, Starbucks. So what is the advantage? There are so many coffee shops in United States or around the world, and even Coca-Cola. There are a lot of drinks, but and Coca-Cola is nothing but it's like sugar water, and we know a lot of things that going around Coca-Cola. A lot of people made joke of Coca-Cola, but it's still making a lot of money. The reason being because of the brand, right? Even Starbucks. So we are this is what is moat. Moat is nothing but they should have a brand value. There are a lot of iPhones. Sorry, there are a lot of phones in the or a lot of brands, but we still, like my daughters, when they say I want to buy them a phone, they don't know phone, they just don't know iPhone. If there is any other phone, they think it's not a phone. So that's the brand value. Because of the brand, people will pay the premium. Starbucks coffee, whatever they make, it might cost them maybe $2 or hardly $3, but they sell it $5 to $6 because of the brand value. Okay, so that is very important when you are actually investing in a company. A company should have a brand, solid brand, that will help for the company to make money. That means if they are investing, investing whatever the returns they are making, and if they reinvest that amount, they are going to make money with their because of the brand. And the second and third second thing as part of our moat, what we need to look at is the pricing power. If now you look at McDonald's, Chipotle, even in when we have inflation, their burger might cost earlier, last year, maybe $4, or like Chipotle, they might be charging $7.50, whatever it is. And when it comes to inflation, when they increase the price, right, still people are buying Chipotle, right? So McDonald's are still running. So even in the bad times, when a company increases the price, can it sustain? That is what something we need to look at when we are investing in a company. Okay. And the third thing is high barriers to entry. This is very rare. I mean, I know there are few companies that made really good. That is like kind of Tesla. Auto industry, first thing is like nobody wants to come into auto industry because it's a huge deal. They have to invest a lot, and they need to be successful with all the competitors what they have already, like GM, Ford, so on and so forth. And no auto, most of the auto companies are not really profitable. So that's the reason most of the businesses do not want to really come into our auto industry, but Tesla is something else, right? And again, Boeing, we have there are only two flight manufacturers like Boeing, Airbus. So if Boeing, so they to come into Boeing or this air manufacturing planes business, it again needs a lot of investment. So we need to find businesses they have they are solid, and people, no other business want to again start easily. It's not like, I know McDonald's, so many restaurants can still come, but because of McDonald's are still running. But if we have a high barrier to entry, that is also becomes an advantage. Okay. And the other thing what we need to look at is the network. So YouTube is very popular. So I know if I post a video on YouTube, people will watch. I mean, they don't have any other option. So everybody will post. So that network and WhatsApp, if somebody is using some other WhatsApp messaging app, and if everyone is using WhatsApp, what happens? That guy, whoever is using other app, will also switch to uh, WhatsApp. So just Microsoft, we are preparing Adobe. So these are all companies I think I've taken here Microsoft, Adobe here, but Microsoft, Adobe is also as good examples of network effect, right? So if I'm preparing a document or in Adobe, you need to have Adobe to open, or if you want to edit. So it's kind of network. If most of the people are using, you end up using. So that network effect is very important. And switching costs, again, I'll take examples of Adobe and Microsoft. If you are using learned Microsoft by paying because that is MS Office is the most powerful. And tomorrow if something else comes, you don't want to switch to that because you already know, even though you are already learned so much that even if Microsoft costs a bit more, you'll not switch, and you can still sustain, right? So that's another advantage. Okay, so I'll just take some, I've taken here a couple of examples. We already know what is Amazon, but I just wanted to put a few things what is we just talked about the moat, what kind of businesses, what we, to invest, right? So why Amazon, right? I just taken an example of couple of examples here. I just wanted to go through it. Amazon, we call it as one business, but if you look at it, Amazon, I think I've already shared this also in once in Discord, but Amazon is it's mixed of 5 businesses, they are into retail, e-commerce, their logistics, they have media business, they have cloud computing, They have like advertising business. So if we buy Amazon, that means we are buying 5 businesses, and at the same time the money they're making in every business is like huge. And and also, like as we were talking about all the modes, right? So if you look at, they have uh, I mean, we do have like Walmart, but like other websites, but still Amazon is very popular, that like most of the online businesses, if you wanted to buy anything, we just always go on Amazon. And we have very few, like OTTs, like Netflix, AHA, or Prime, but like but if you look at it, like AHA, I know it's regional, but I'm just saying, like, but Prime is like universal right now, Netflix. So there are very less competition there, but they have also this retail businesses. So cloud, they have started, and slowly now Google and Microsoft are coming into the picture, but still they're holding huge share in the market. So and logistics especially, they are actually investing in the logistics business, and they are now crossed recently UPS, I guess, um, because of the shipping costs what they were like incurring. So they wanted to invest into logistics, so that like for them the shipping cost will become less. And they are into advertising, media business, so many things, right? So when you look at a company, you need to look at something very, very strong when you wanted to invest. Okay, so this is one thing, but we'll also look at the financials. Like business is strong, but whether they're making money is also important. And also I've taken one more example, like Mercado Libre. So this is also called uh, Amazon of Latin America. Okay, so they're also like into e-commerce. They have logistics, and most of the products, whatever they ship, 90% of them, they have NVOs, their own business. That's their logistics business. And they have Pago. It's a payment processing and gateway services business, just like earlier PayPal and eBay, right? So eBay used to use PayPal, so and they used to run 2 different businesses, but still PayPal used to have like their own business. They were making money, eBay was making money, but Mercado Pago is their gateway services. Whatever they process the payments, they also have, they make money there. And also they have lending. So if someone wants to credits, like they give loans, so on and so forth. So and they're making I mean, that is what, like they are into multiple businesses, and they're very rare competition, and they're making good money. Okay, so this is what actually like whenever we are investing, first and foremost the key is it should be a strong business. That is clear, right? So now coming to financials, right? So I'm making it very simple. I know it's like um, because as I said, like if you wanted to understand income statement, balance sheet, all these things, it's going to take like time. But I'm just going to break down into 2 today, without even going into all those details. How can we simply calculate and understand the financials of a business to invest? And this is the first valuation method, whatever I'm talking about now. It's very simple, but it has its own limitations, but we will talk about the limitations. But the simplest way, if we wanted to simply like understand the business without knowing much technicals, we can actually um, take peg ratio of a company to look at it. And the industry benchmark or rule of thumb is, if peg ratio is less than 1, that means you can go ahead and buy. But again, this applies, as I was saying, like there are some limitations. This will only apply for the companies which are making money consistently. Again, anyways, that is what the companies we want, and that is where we invest. But again, the limitation of this peg ratio is, it is purely, we will look at the only earnings. This calculates based on the earnings. So that is the reason we might not prefer, but we'll still look at it. And we can understand, like what is peg ratio, and then and we'll still, like, if we have any companies on Finviz, I'll also show you how to actually how to screen the stocks or the businesses that are actually trading with a PEG ratio that is less than 1. Okay, so first let's understand just what is PE ratio. PE ratio is nothing but the share price, the current share price, whatever we have, that is divided by earnings per share. So that will give us a PE ratio. Okay, and if we take that PE ratio and we divide it with EPS growth. Okay, so when I take earnings per share, we always take the trailing 12 months. And when it comes to EPS growth, we always take the 5-year, like, you know, the next 5 years, how the company is going to make. So that gives us like the PEG ratio. And as I was saying, if PEG ratio is less than 1, we can just, like, you know, think that the company is, like, you know, undervalued, and then we can invest in the company. Okay. Okay, so let's now look at here. Okay, so P here, I was just saying, like, you know, how we can get the P. We don't even need to calculate. That's the reason I did not put the formula here, P ratio, because we on Finviz, if you go to Finviz, we will actually the P ratio is already calculated. But as I was saying, like, you know, P ratio we will get by getting it share price divided by EPS. So EPS is already here. So if you divide bookings, stock price, whatever it is, bookings share price divided by EPS, we get this PE ratio. Okay, and now what we need to do is, like, to get the PEG ratio, we take this PE ratio and then we divide it by with the growth here, like, you know, I've just highlighted here. So we divide this, and if we get less than 1, so now the current price, so PE ratio is 34, and the EPS for the next 5 years, if we take like 50.5, that is divided equal to, it is giving 0.63. That means the booking stock is currently trading, or it is undervalued, we can invest it. So that's the idea. That's how we can evaluate a stock based on the PEG ratio. Okay. So this is a very simple method, as I was saying, but it has its own limitations. I was just talking about it, right? So, and if you wanted to actually go ahead and search on Finviz, you can just go to screener and select market cap as large or mega, and you'll have a filter here that is PEG ratio, that is under 1. If you select under 1, you get the stocks. Okay, list of stocks. But again, like, I can just go ahead and show you that. Okay, so we go to Finviz, you go to screener, and you can actually, first market cap will be under like descriptive, so you can just go ahead and select large cap, and the PEG will be okay. So let me go here. So PEG ratio is, like, you know, under 1. Okay, and you get all the stocks here, and you can actually go and look at this companies. Okay, but again, I prefer, like, you know, large or mega caps. But yeah, usually we don't, like, you know, go to small caps on this. Okay, so that's how we look at the PEG ratio if you wanted to bring some stocks. But again, as I was saying, this has its own limitations, because why we this is very simple, right? So one can, oh wait, like, you know, it's very easy, I'll go and like pick some stocks and go and start investing. But as I was saying, like, you know, there are some limitations. The company should be making money, and it is not always accurate, and it has limitations. The reason why is because as this is calculated based on purely earnings, company you know, can make money, let's say by selling a building, like, you know, they have a property, they sold. What happens is suddenly they get like so much of money by selling that, like, you know, building, right? So then suddenly it looks like, you know, PEG ratio is undervalued. But what happens is, like, it's not true, because it's not they did not make money by, like, you know, it's not like the income what they got, like from the business, right? So it is based on the one-time settlement whatever they made, and it looks like very less, but end of the day, like next quarter or whatever it is, then the PEG ratio might become more than 1 as well. And also, like, the capital expenditure, if a company is doing, like, a lot of capital expenditure on the businesses, then their PEG ratio might look might look huge, but end of the day, if they're really making money, it might still be okay. Just like the case of Amazon, they're spending like a lot of money even though they're making a lot of money, and even Meta is the same case. So some cases you might feel, you might see that PEG ratio, even though it is more than 1, but it's still a profitable business. So that's where, like, it becomes a little tricky, even like at the and mergers or acquisitions, like Adobe bought, like, invested 20 billion. That means they paid 20 billion cash. So then suddenly their bank balance, they bought Figma, right? So suddenly the bank balance comes down and the PEG ratio might seem high, but still, I mean, Adobe is a great business, as we all know. So that is the reason PEG ratio is like, can be used, but it's not really the one which we need to look at it, but it's good to know, just to understand. Okay, so what is the other valuation method is, like, DCF, that is what is discount cash flow. Okay, let's talk about it. This is what Warren Buffett strategy on how he actually calculates the intrinsic value. Okay, okay, so let's understand, this is the valuation method. This is like the most popular method that is used to calculate intrinsic value and invest in a business, right? Okay, so now there's a company that is making money today, like, in 22. So what is discount cash flow? I'll just give an example. So sorry, just a high level, very high level, I'll give a definition. So discounted cash flow is nothing but, let's say if a company is making money $100 this year, okay, and the company is also making $100 next year, and the company is making another like $100 like the third year as well. But what we do is, like, we if we wanted to invest, like, today, we will discount the cash they're making in the future, because the value of the money will be reduced, because what is $100 today may not be worth in the future. So we discount that amount and calculate the value with the current price. So that is what is discounted cash flow. Okay, so that is what is very high level, but let's look into it, right? So let's say in 2022 a company is making $100. Will we and let's say, I mean, we should be okay to pay $100 for this stock, because it is making money this year. Okay, and we'll come to this net present value, how to calculate. I'll show you, but before that, we'll just go into this. So if your company is making $100 this year, we are okay to pay $100, right? So but if a company is making $100 next year, will we pay $100 to that company? No, because as I was saying, the amount whatever the company is making in the future, the same money worth may not be $100. It will be less than $100. So that is what we calculate. We do it. I mean, that is what is net present value. So cash flow, whatever they're getting, the cash flow, that is $100, we divide by 1 plus discount rate. So discount rate, usually, again, the discount rate, to calculate discount rate, I'll take it later, but I'm taking a 10% discount rate based on like whatever, right? So here now, this is just next year, right? And this discount rate, power n, that is the number of years. So now if a company is making next year, so what happens if we take 10% discount rate? the 100 divided by whatever we have the formula, right? 1 plus 10% if we deduct, the value is $90.90. So for a company that is going to make $100 next year, are we okay to pay $100? No, right? So it's worth only $90. Okay, now let's say the company is making money that $100 in 2024. Do we pay $100 now? No. Do we pay $90? No. Because the value of that $100 today will be $82 based on the future. So that is the reason the difference between growth stocks and the value stocks, that is where makes a difference. We don't know like how much money they make in the future, so we are betting, and we, without knowing anything, we just buy it for a price that we do not know how much they're going to make. But again, like even if we take $100 that they're going to make in the future, still if you want to buy, that means predicting that it can make $100. So we, as I was talking about, 1 plus discount rate, that is 10%. Again, I have taken the same 10%. Now power 2, because this is like they're going to make money after 2 years. So this is what is called discount cash flow. So we take the discount of the money they are making and we invest it. Okay, now let's see. A company is making money $100 this year, and they're going to make $100 next year, and they're going to make money consistently $100 every year. Okay, now how we calculate, right? So now we take the $100 this year, we take the 90/90. This is 90/90 is the discounted cash flow, what based on our NPV, whatever we have calculated, and then next year's value 82.64. That is again like based on the 2 years 82.64. When we actually add all this, that's where like we get 273 divided by the like number of shares, that gives us the fair value. Okay, so this is very high level. I mean, just to like make you hope you understand. So that is what we look at. That is what is called discounted cash flow. That's where like and for us, if we are investing in good companies, we wanted to make sure that the companies are making money every year. So that is the safest bet. Okay, now let's look at the same thing. I know, like we just simply put things together to understand, but now the same thing, if we look at like let's take Apple as an example. Okay, so what are the components? I know it's, we just like I'll just give an example, but we don't just add it, and but we also need to take few more things into consideration, right? So now how do we calculate the fair value or the intrinsic value of a company? Okay, so we need to consider the EPS, earnings per share, trailing 12 months, whatever it is doing. And we also need to consider the growth rate. This is what I was taking, how much money they're going to like make in the future, and also the discount rate. This discount rate, how we calculate is there is a separate formula for now. Let's understand that we are giving a discount rate of 9.36 for Apple, and with a P ratio of 20, how much money or what will be the price of Apple stock that can be in the future, right? So based on this, in 2022, the fair value of Apple is 126. This is, I have already calculated, based on which I'm actually listing here. And 2023, they're going to make, I mean, 2023, in 2023, it would be 137, 2024, so on and so forth. So current intrinsic value based on whatever they're going to earn, the intrinsic value is 126. That is the fair value, and the current price is Apple, and it is an upside 14.76%. So that means I'm not going to invest in Apple. That's the reason I don't have Apple stock in my portfolio at this point of time. Okay, okay, let me see what. Okay, now Now what I have done is actually how I have calculated this intrinsic value. I have actually, okay, so I will share this spreadsheet. Okay, I have actually, because of the time limitation, we have just 1 hour, I can't go through everything. But what I have done, I have actually put this intrinsic calculator in a spreadsheet. What you can do is you can go and take any stock, but this is, again, I have not calculated. I mean, there are some more components which need to be added to this, but for at least to give a fair value, this will help at least. Okay, so what you can do is you can go and input any stock that is like, you know, Microsoft or whatever it is, Meta, whatever, right? So okay, so this is this just calculated, auto calculated based on the inputs what are already there, but we need to change this now. Okay, so EPS TTM, right? So where do you need to get all the information? We get from finance.yahoo.com. So what I have done is I have put a comment in the spreadsheet. So this is a Google sheet, so I can share it with you guys and you can just go ahead. And so I have put a comment here in the comment section. If you go like, you know, to every tab, so the ones which are in yellow, that those are the values that you need to enter, and the green ones will automatically calculate it. So if you go to this comment section, it will show you on Yahoo Finance, go to summary tab to find EPS trailing 12 months, and then take that value, enter here. The same thing, go to Yahoo Finance analysis tab, scroll down to growth estimates, and take the next 5 years growth rate. Okay, same thing, PE ratio, where you need to find. And I know I was talking about discount rate, how this is calculated. The discount rate also you need to actually calculate for every stock. How do we calculate the discount rate for each individual stock is here again, because we cannot take the discount rate for every stock, and because the sorry, discount rate also varies from stock to stock, or right, business to business. So because we need to take some, like, you know, short term, long term debt also varies from company to company. So I've again put all the comment section in the comment section here. You can just go ahead and take those values where to get from and key in. So based on that, the discount rate will be calculated automatically. First you need to enter this, and then once you get the discount rate, enter the remaining things so that you get the fair value. So what happens is this will give us a like at least high level, whether you whenever you are buying a stock, whether is it like, am I paying the right price to the stock? Otherwise, like, you know, if what happens is the goal or the main aim of our investment is that to get profit in the future. But if we do not know what price we are buying, and if we just buy for the sake of buying, and end of the day, 1-2 years later, you see, you know, what happened, why I did not get the returns, is because the price whether you paid is right or wrong, that we do not know. So this calculator at least helps high level, and this is what is Warren Buffett's strategy whenever he's buying a stock. Okay, and once I share, if you have any questions in the Discord, you can always message me. I can help you understand a little bit more if you're stuck anywhere, so that I can just guide you on how to do this. Okay. Okay, let's go back to our PowerPoint presentation. All right. So now we have seen, okay, now we know what is intrinsic value and we are ready to buy, right? So now let's say Microsoft, let's say, I mean, I'm just saying, like, right? So Apple, let's say if it is really trading undervalued, now it is overvalued, but let us say it is trading at $100. Okay, as soon as we see $100, we go and let's say I have 100K and I'm planning to invest in, let's say, 20 stocks or 10 stocks. Let's say 10 stocks, simply to just simplify. Okay, so what we will do is if we have 100K and if you wanted to buy 10 stocks using 100K, that is 10K. Okay, as soon as we see $100 stock, okay, I have 10K, it is undervalued, we go ahead and buy. No. Okay, so that's where, like, you know, comes our DCA. dollar cost average? I know there is a big misconception um, about dollar cost average, like because people do not understand what is dollar cost average. Okay, they think that I go and buy any stock for whatever the price, and when it goes down, I'll add more. If it goes further, I'll add more. If it goes further more, I'll add more, and end of the day, it will never come back up, and they'll either sell it or hold the bag forever. Okay, so first thing is, as we were just talking about the fair value, right? So we need to first we need to understand, and this we need to understand the company, we need to understand the fair price of a company, and if it is overvalued, we never buy. But what we do is we just think, okay, I'll buy a stock, any stock, it could be pharma, whatever it is, right? And if it goes down, I'll add more. If it goes down, because we think one day it will come up. Why will it come up if it is already trading at a overvalued price and it's not worth anything? And if the company is not worth anything, if it is just trading for $100 and it fell down now, like, $80, and tomorrow $60, and tomorrow $20, and if you keep buying, and if it is not even worth $10, why will it go back again to $100? There is no way it will go back to $100. So DCA is not about buying a stock and keep adding the stock to just make it average. No, that's what we need to take out the first and foremost. DCA is not all about that. DCA is, first we understand, as I was talking about 100K investment, and if you wanted to pick 10 or 20 stocks, now first calculate the fair value. What is the fair value of a company? Like now we have just seen, let's say 147 or 126 is whatever it is, Apple's fair value. Now, will you buy it fair value 100 and let's say $25 is the fair value? Will you buy 125? No, I will not buy at $125, even though if it is if it is at the fair value, right? Because if I want it to be profitable, I want it to buy less. And now you can ask me, okay, if Apple's fair price is 125, why will it trade for less? Yes, it can trade for less, and it will trade for less. Now we are seeing so many stocks are trading at a lower price, below its fair value, right? So that's what happens, like, the economic situations, that's where it comes. And when you have 100K, and last year almost all the stocks were overvalued. So what should we have done is, we should have not bought any stocks last year, any stocks, zero investment. We should have sit tight with our 100K cash in our account to wait for the right time to buy the stocks. Okay. Now, can we, like, even though we predict, okay, Apple, let's say Microsoft or whatever it is, right? The fair value is 320. It came to 300. Okay, we'll discuss about that. But key thing is, now when we calculate the fair value, we identify 5 key support levels or resistance levels with 100 with around, like, I'm just giving a ballpark range, 8% to 14%, but you can just, like, depending on, like, the stock, like, we can still manage it. But this is overall what I think. Once you buy a stock, like, once you pick, like, 5 spots, the 5 spots should be at least 8% to 14%. Okay. So that means if I'm investing in Apple for, let's say, like 10K, when its fair value is 126, I'm just saying Apple again because we just saw the fair value. When it goes to, like, 110, from 125 it's fair value 110, maybe you buy like $2,000, and then identify like that. Below, if it goes another 8%, then, or to 8% to 14%, then buy another 2K. Like that, we need to start buying the stocks. Okay, so patience is the key. And buying or selling, or even for holding, investment is not a magic. Investment is all about buying a stock and holding the stock for long term after buying below its fair value. Okay, so patience is the key. As I was saying, even for buying, because if it is like, if it is going high, don't think, okay, it is going high, it will never come down. And like don't do that, right? So because even to buy we need to have patience, even for selling we need to have patience. Okay, so investment is all about patience. Okay, so this is what I was explaining. If a company's fair value is 220, where do you buy, right? So again, you don't buy just randomly like 8 to 10%. First identify, if it goes to 200, just check whether it is a strong support. We always buy at the strong support levels. Okay, because the reason is the stock could bounce from here. So if we have the 10k whatever the value, right? So if Microsoft, let's say it from 220 it came down to 200, buy $2,000 stocks only. Okay, keep the remaining 8,000, and again it goes down to 185. See if it is a strong support, then go ahead and buy few more. Okay, same thing like that. You bought all the way, it came down to 125. Now you bought 10,000 rupees. Now look at, even though the stock price went to 125, what is the average price? If even if you buy, the average price is 165. Okay, and what is the fair value? 220. Even though stock today, because of some economic issues or situations, the stock could go lower, but when you are buying great companies, don't worry. Okay, because like, if you buy bad companies, I was saying, for the sake of buying, they will never ever come up. But for a company, if it is good and if it is fair value, it is making money, and if its fair value is 220, 101% it will come back to 220 no matter what, unless if the business is going bad, or like, some issues. Other than that, if the company is good and whatever we have discussed about, like the company's moat, it's making money, you will never ever lose money. Okay, just remember this. Okay, so now what, like, even though your average price is 165, the fair value is 220, 33% discount you bought. I know, I mean, like, 33% discount, you bought it. Now you can ask me, like, what if the stock goes 125 to 100 and I'm done investing my $10,000 on this stock? Don't worry, just, even though it goes 100, 80, 70, don't worry at all, because if you are if just like, because this is like not a pharma or biotech stock that can, like, go to zero. These are the stocks, companies, again, like I'm talking about, if you invest in good companies, even if they go below, like whatever you think, then it has gone, still you can go to sleep happily. Just as I was saying about patience, hold it for like 1 to 2 years or 3 to 5 years, they are going to come back to their fair value, and they are going to trade more than fair value. Okay, so this is what I have seen. We have seen like how we actually, when it's going down, how to buy, right? So now let's say like the same situation, the fair value is 220, but the stock is at 155. You can apply the same strategy. Now, like, you have 100k, you have not invested. Now you have calculated the fair value 220k, and like, how to start, like, investing those 2000, right? 2000, 2000s, whatever, 10,000, right? So first you buy like at 155. As soon as you see, okay, it's undervalued and it's like I'm getting very much good discount on this, so you start, don't buy again like 155 all 10,000, because you never know, right? It could go lower, so wait for it. And if it is going up, it's okay. Then, as we were talking about 8%, whatever, just go ahead, buy another 2,000. And if it's still going up, buy 2,000. So if the stock keeps going, you can either, when it is going down or up, once you see it is trading under fair value, you can still buy, go ahead and buy, even if the stock is going up, but if it is below fair value. Okay, now even in this case, if you look at, if you buy something like this, I have calculated the average price is 182. Still, you are getting a 20% discount on the fair value. That means on this return, a minimum return what you can get is 20%. And if the company is growing, okay, so what we do is like, we now the thing is, will the fair value changes? Yes, the fair value can change based on its quarterly results, or I mean, not just 1 quarter or 2 quarters, but year over year, right? So next year, if the company is making, because these companies, good companies, they whatever the money they are making, they're in there. So that is one of the key components what we need to look at. Like, if you look at like Google, if you look at Microsoft, how they're like, they're like, if they're making 10 billion this year, they're making 20 billion next year, they're making 40 billion the later year, right? So, and that, because of which the fair value we need to calculate maybe yearly basis, and see, like, based on this year, how they can actually how much more. So if the fair value keeps increasing, so you can keep holding until the company making bad quarters, like at least 3-4 bad quarters, you see they're really losing money. Then you can think of I mean, obviously the fair value obviously will come down, and then you can start selling. But again, we'll come back, we can discuss on the selling, right? So selling is this also the same thing. Once you understand the fair value, and let's say 220 is the fair value we just discussed. Now you bought like 220. Will you, as soon as you see 220, sell everything? No, wait for it. Okay, sell some at 220, but again, you don't sell as soon as you see 220, because when we keep recalculating, and as I was saying, the companies will make money, the fair value could actually go up. That's the reason, if you look at like from last 5 to 10 years, how much Google price from where it is to today, right? So as long as if it is keep making money, you can recalculate the fair value and can see how much money they're making, and the fair value could change. So then you can wait. But if the fair value is stuck, then you can think of like, because when a company is getting overvalued, then you don't want to hold the stock as well, right? So you can just see like, 220, sell 2000 stocks, whatever, right? The next 235, sell like remaining more 2000, and like that, whatever, like, 5 times if it going up, because you don't want to hold. If it is 220 and if the stock price is 35, you don't want to really hold, because end of the day, it's going to come down if the fair value is not going to. So that is how you need to sell. I mean, even the selling strategy, you need to have a selling strategy. So that's where, like, you can go ahead and sell it. Okay. Okay, now we have discussed buying, selling, everything. Now you think like, this all very complex. How can I just like, intrinsic value, I don't understand all this, like, income statement, bank statement and all, like, right? So then still be fine, because we have some websites that are actually already doing this. Okay. To understand the fair value, right? So you can actually go ahead and subscribe because if you really do not want to spend time and just go ahead and understand the fair value and do it, then you can actually sign up. Like, there are like this good websites, Guru Focus, Simply, Wall Street, Morningstar. They also give you all the, I mean, they'll also give you the fair value, but be conservative when you see those, like, the fair value what they have, because they have their own calculations. Usually I'll be conservative when I'm actually doing the discount rate and all. So be conservative, whatever the fair value, just put it like $5 to $10 less, so that you'll be on the safer side. But it's always good, you understand the company, you understand the financials. If you can calculate by yourself, you'll have more confidence, but it will take time, but initially. And good part of this like websites is it's like a multi login. If you can, like, 50 people, 20 people, whatever, if you know your friends, you can just go ahead and actually group them together and say, this is like $100 yearly subscription, can we all do together? Like, then if you have like 20 people, $5 hardly, right? So and like, yeah, anything, like, you can subscribe initially if you wanted to really understand the good businesses. Okay. And yeah, I mean, you can actually go to these websites and like, right? So they have like, let me go to Microsoft. And I think for some of them, it actually already gives you without even, so if you go to DCF, you don't even need to go to DCF, but yeah, see, look at here, right? So they have already calculated, I did not even sign up, but I can still see it. Fair value is 256 by Microsoft. And look at the growth. rate based on which they are calculating, so and so forth. Discount rate, they have given 10% here. So you can actually go and like, I think this is like, I have not even subscribed, but I can still see it. But you have like, Simply Wall Street, again, that is actually a paid subscription. But yeah, this will really help, if until you understand the like how to calculate these things, right? So that it will really help to do it. Okay, so now I have also listed a couple of other websites. Now you can like, you wanted to understand what stocks to pick, I don't know, like, then you can actually simply follow our super investors, superheroes. Okay, so there are a couple of websites I have listed here. So what you can do is, this is data Rama. Okay, you can just go to this website. This is a very, very, very good website. You can actually see here in the what are the top 10 most owned stocks. Okay, so Google, Microsoft, Meta, Amazon, and you can actually see top 10 buys last quarter. What are the 10 buys that are done in the last quarter, Q3 22? Meta, Microsoft, Amazon, Google, Visa, Booking, PayPal, Disney, right? So you can actually, at least it will give you an idea what these Warren Buffett, Bill Ackman, these great investors are buying. So if even you can go and see their buys, what they have done. Okay, so I really like this website. So if you go to Bill Ackman, and you can actually see here Lowe's, right? So he bought Lowe's. If you click here, it will show you how many stocks he bought, how many stocks he sold. So Bill Ackman, he actually reduced position in these two, and he added 1.64. I think this is, I'm not sure what stock is this, but yeah, let's say, let's see if I have this Warren Buffett, like, right? So we go to Warren Buffett. Let's see what he did. Activity, you can go to activity, Q3, what he has done. Okay, so you can see Oxy, he has added 22.5%, how many shares he bought. So at least you can understand, if you really wanted to know what, because it's like, these are great investors, so you can just go and maybe, I mean, again, it's not good just to copy, but when you are actually seeing, when you're seeing, like, Warren Buffett is buying this thing, uh, at least you can, he has done some work, and you can also do some more work to understand the company, what it is, and so on and so forth, so that it will give you more confidence. So he's still adding Apple, he has added more Apple, and yeah, I'm just giving Warren Buffett, but Monish Pobre, like, there are a lot of good investors. Every investor, whoever has invested, you can get how many shares they bought, how much they have invested, how much added, so on and so forth. So this is one of the best websites I would actually suggest. And this one is similar to Data Roma, but the difference is, this will actually, wait, I don't need to sign in, right? Okay, yeah. So this is Data Roma will only give US stocks, but Ticker will give you like other like, if they have invested, like, they bought, let's say they have invested in a Chinese stock, right? So that is not US stock, ADRs, right? So you can actually, Berkshire Hathaway, you can just see, like, what they have invested, right? So you can see. So there are some stocks that are not ADRs, that will also be shown here. So that is the only difference. But again, even here, you can see all the super investors are like great investors, what they are doing, where they are buying, so that you will get some confidence, like, right, so to invest on those stocks. And yeah, these are like, as I was saying, Finbiz, just to screenshots if you want to filter some stocks. And QFS.net, this again, the intrinsic calculator, whatever I have actually put here, I have put like from Yahoo Finance. This YF is nothing but Yahoo Finance. But if you want to, actually, this is another great website, that is quickfs.net. Even this, you don't need the subscription. So, but you can actually get all those details from here, like say Apple, right? So look at this, right? So it will give all the key statistics. You can take these numbers from here to for us to calculate. So this is another great website for you to have and to know, will really help. So these are like, really powerful tools that I use actually to understand things and to invest. Yeah, so now, like, investing is all about patience, and I was saying, like, right, so even like I'm investing, this is my portfolio, listed some of the stocks. Even I'm down, I'm not saying like, oh great, I mean everyone, like, this year is crazy, but based on like what I'm buying, how I'm buying, all the like, tools, strategies, what I'm using, I'm still down on like, some of the stocks. And overall total current, my overall profit loss in my portfolio is 9%. I'm down 9%. And I'm like still profitable on, like, I'm still in this market currently. To be in profit is something. And so I do have, like, booking, like, a couple of stocks, or and Melly I'm up 11%. Just like I was using the same, like I was saying. But I'm even down on some of the stocks, but not that bad. Now I'm down 10%. Amazon, I'm down 20%. Amazon is the one I've started adding, like, very early in, like, this year. But that is the reason. Amazon and Google are the ones, like, I've started adding first. But I actually still have some, as I was saying, like, 10,000, if you wanted to invest 10,000, right? So I still have that, like, last I mean, I have invested 6,000 of like my 3 parts. I'm still waiting for Amazon and Meta. That was a great chance to add it 80s. I just thought, like, because of Meta, I just added like around 111s, but my average price is currently, this is my average price, where I have bought, and this is the current price. Okay, so this is the good thing what I would all suggest, right? So this is how I maintain, and so what I have done is, like, this is my stock and this is my trade price, and this is the current price. And current price, I don't really have to enter if you are maintaining in Google Sheets. The Google Finance, I'll just you use the formula automatically. It brings the price every day and then automatically calculate the percentage on everyday basis. So I don't maintain this every day. I have just entered, but this I have calculated. So what I have done is, I have calculated the intrinsic value and I have put it here. I know the current value of whatever, wherever I bought, it is still less. So from intrinsic value, where did I trade? So for me, 11%, I bought, my current trade price is 11% lower than intrinsic value. So I'm tracking here. So what stocks are, how much is the discount, right? So I'm tracking that so that I can know once it hits that intrinsic value, I will start looking at what is the next step, right? So I was telling like about if it goes beyond, then I start. But if it is less, I'll as I was saying, like, there are more stocks that I need to add. So I still have to add. So I'm waiting for the right price. Meta I should have actually added when it was below 80, but as the Zuckerberg said, like, it's going to they're going to spend more money next year. I thought this is not going to go, even if I invest, like, this year, like, I'm not going to get the returns sooner. So I waited. Otherwise I should have added. Actually, I made a mistake on that. But now Zuckerberg again come back and said, so I might again, like, even Meta, I have 2 more ads that I need to add. So I'll do this. So this is how I track and maintain my portfolio, just to understand whether the stock is under discount, and if it is, then I'll just go ahead and add. I think I know we are a little over time, so I'll stop here and take questions if you have any.
Yeah, thank you so much, Ram. It's so much wealthy of information and many insights. Let me check the chart. So Sailajagar is asking how to evaluate banks or financial institutions and rates.
Good question, Andy. So we actually, the whatever I have actually we have shown like the intrinsic value or discounted cash flow will not work for like banks and REITs. We have a different valuation method for those. So if you are interested, I can share, but most of like I mean, I know most of us because the thing is banks, we don't like, I mean, I have not like, it again depends on the situation, but usually tech, consumer staples, these are the ones which we usually or like retail, so these are the ones which we usually trade. So this, whatever the IV calculator that I have shown will work for those, but for banks and REITs there is a separate. But if you're interested, I can share that IV also on how to calculate.
Thanks, Vinny.
Yeah, thank you, Rama garu. So the next question, RK garu adugutunnaru, is Netflix comes under bad category, and what about Meta?
It's not about category, and it's a good business, and it's all about, I was saying, right, until like Prime and Disney, they were the only ones on the OTT, and they were making good money. But again, as I was saying, it's a good business until like someone comes, but still it's Netflix is great. But again, like we always need to look at the intrinsic value, where it is trading. If it is trading below its fair value, then it is okay to invest. But again, Netflix moat is not as strong as other companies. So anyone like now Disney, Prime, like, so tomorrow someone else can come and like so then obviously so it's not a great moat. So that's what I meant. But if it is a strong, always look at wide moat. Wide moat is, I was saying, like the moats we were talking about, right? So if you have a wide moat, I don't think Netflix comes under wide moat. So it could be like like normal mode, I would say. So I would actually prefer like wide mode stocks mostly. And Meta is a great business, except that they are just burning the cash, but still they are earning a lot of cash, and it's way undervalued. I'm investing, and I'm going to add more to Meta, no doubt. If even if they say they are successful in metaverse, or even if they say we are now stopping metaverse, then the stock will skyrocket. And they are still making lots of money. Okay, so Meta is still a great stock to hold or buy.
Yeah, why? So, like Meta, do you think like దానికి ఎగ్జిస్టెన్షియల్ థ్రెట్ ఉన్నట్టు ఉంది కదా? సో వేర్ ఆర్ దే మేకింగ్ మనీ ఫ్రమ్?
They are making money from their family apps business, and if they are making money from Facebook, they're making money from Instagram. They have not yet monetized on Reels. They have not yet monetized on WhatsApp. If they start, Zuckerberg already said they are going to monetize. They are going to start slowly monetizing on these apps, and they are making tons of money from this family of apps already. And if they start like monetizing these things as well, and they're going to, and it's going to add more. So currently they're not making like very little on metaverse, very minimum, and they're investing a lot, but they're making tons of cash from this family of apps on advertising and all, right?
Yeah, sure.
Thank you, Andy. Next question is Giridhar asking, can you please name 5 stocks under fair value to invest now?
Yeah, I've just shown kadandi na portfolio lone. I've just shown like but again, don't go everything in tech. Like if you have seen, I have invested on like Amazon, like I've invested in Weave, I've invested in TSM Semi. So yeah, I mean at this point of time, everything, like most of them are undervalued, even all the good stocks. The reason I'll tell you why is that because of the interest rate, right? So for companies, the interest rate, we call like the fancy word is yields, right? So currently, because what happens if the interest rates are low, the growth rate or the companies, the fair value automatically keeps going up. But when the interest rates are high, the company's fair value comes down. That's the reason the stocks, and again, like because of various things, the stocks are down. But yeah, most of the stocks are undervalued, like what I have shown in my portfolio. But yeah, I can share more if you want, like.
Thank you.
Yeah.
So thank you, Andy. Next question is, could you also please share the Excel sheet?
Yeah, sure,
you-
Andy. I'm going to share the sheet. Yeah, Excel, the IV calculator sheet. Yeah.
And many are saying Venkat Garu and Rashekar garu, like excellent session, Rama Garu. Sai Garu asking off topic, how to do tax loss harvesting and capital losses?
Okay, so that I think we can have in a separate session, Andy. So I think I'm not the right guy to answer that, but yeah, we can maybe take that question and come back on that.
Sure, yeah. So Girdhar Garu asking, is it right time to invest in tech stocks right now?
Yeah, I mean, absolutely, Andy, without any doubt. So only one thing, as I was saying, right? So what we need to look at is the fair value of a stock. If a company is trading below its fair value, again, as I was saying, don't invest all those 10,000 at once. Just start investing slowly, like 2,000. Just wait, and 8%. Around 8% to 14%, I was saying that if it goes down, like just keep buying again. So keep investing, like that's how the investing strategy should be. And this is definitely the right time. And there is, see, we never ever know, no one can predict the bottom, and it's very, if someone is saying I know this is where the stock going, they're just fooling you. Okay, so we don't know the stock. Meta, like, or Microsoft even can go to 200, but I don't know, but I cannot predict that. So that's the reason I keep buying the stock, because if we wait to buy at the bottom and we see, like, the stock is going down, we never buy. And once if it comes, like, when you see a price of 220, and when it goes up to 230 or 240, oh shit, I should have bought, now it's $20 up, I don't want to buy. So that's how we feel. But when this is intrinsic value, either if it is going up or down, I don't mind, as long as it is under less than trading under intrinsic value, I'll go ahead and buy. And that is how, like, as I was saying, we never know, as I was saying, right? So if it is 125, you ended up buying, and if it goes to even 80, don't worry, because if you have like 33% returns on your investment sitting, at end of the day, it is going to come back to that 33%. But even if it goes lower, don't worry about it. If you are done buying, just sit and relax. That's what, like, gives the peace of mind when you invest in great companies.
Awesome. So the next question is, how does fair value account for a bad investment like Meta did?
Yeah. So fair value. So the most important thing is free cash flow. Okay. So what happens is, for fair value, the free cash flow makes a huge difference. So what they were doing is, like, the operating cash flow, whatever they're getting, then they're generating the operating cash flow. Every company will invest, and see, all the companies, they have to invest. See, Microsoft never sat just on Windows. They have like, so many things we are seeing, like Teams, Microsoft Office, and they have a lot of, they're into cloud. So every company, when a company is, like, making money, what they will do is, they will call it as ROIC. Every company will invest, but they have to invest. And that is how, like, but the management and the company, what they are investing, because what happens is, there's ROIC is like, great concept again, right? So company today is making $100. They made profit of $110, and they take this $110, and the next year they invest the $110, they make another 10%. That means now they have like $121, right? And they take that amount and they invest again. So that means like in 10 years, the $100 will become $250. So that is what is, like, compounding. The money will compound when the management is good, and they are reinvesting, and they are, like, investing and making money out of the goal is, whatever they're investing, they are going to make money on that investment, right? So I know metaverse is, like, the people's most of the people think that metaverse is something might not work, or might even if it successful, we don't know how it's going to be, how much return it's going to get. but people think that it may not be that successful, because of which, like so I was talking about free cash flow, right? Operating cash flow minus the capex, that is the capital expenditure what they are doing on Meta is huge. So that's the reason their free cash flow is coming down. Obviously, when the free cash flow is coming down, the fair value will come down, but still Meta's fair value, if we compare with the way they are spending, it's still less. So that's the reason Meta is still a great buy.
But in the fair value calculation, you don't have the component for the free cash flow, right? So how can you just account for that? That's the question.
Undandi free cash flow, we will take the cash flow into consideration. I'll share those details, Miku. Whatever we have to take consideration of the free cash flow, that's the whole point. So we take the I mean, whatever, like I have shared, like, this intrinsic value calculators to start with, it's with simple components, but we take, like, long-term debt, short-term debt, we take free cash flow. Those are the key components, the growth rate, discount rate, all these are the some of the key components of the IV.
Okay.
PE రేషియోలో కూడా ఎర్నింగ్స్ ఉంది కదండి, ఎర్నింగ్స్ ఆర్ ఆఫ్టర్ క్యాష్ ఫ్లో కదా, ఆఫ్టర్ అంటే ఆఫ్టర్ క్యాపెక్స్ అండ్ ఆల్ కదా. సో ఎర్నింగ్స్ లో కూడా ఇట్స్ ఆల్ బేక్డ్ ఇన్.
ఎర్నింగ్స్ లో క్యాపెక్స్ ఉండదు కదండి.
క్యాపెక్స్ ఆఫ్టర్ క్యాపెక్స్ కదండి ఎర్నింగ్స్.
నో
ఎర్నింగ్స్
ఆఫ్టర్ ఎక్స్పెన్స్ కదండి, క్యాపెక్స్ ఇస్ ఆల్సో ఎన్ ఎక్స్పెండిచర్ కదా. సో ఆఫ్టర్ దట్ ప్రాఫిట్ కదా.
Oh, you mean the guesstimate for the earnings for the next 5 years? Okay, got it.
Okay, any other questions, Ane?
Sir, Rama garu, thanks andi, thanks for your session. Sir, ఇప్పుడు మనం ఫెయిర్ వాల్యూ leverage ETFs కూడా సేమ్ మెథడ్ లోనే ఫెయిర్ వాల్యూ క్యాలిక్యులేట్ చేస్తామా? దానికి
లేదండి, అది ఇట్స్ డిఫరెంట్, బట్ ETFs కి I need to check అండి fair value usually, but I can get back to you on the ETFs అండి.
Yeah,
so usually I don't
basically,
trade ETFs, so I have not really.
Yeah, I'll trade ETFs. Basically, I'll trade on the boil and cold.
Oh, okay.
Based on resistance and support values, I will sell covered calls, or sometimes I'll do, I'm doing kind of a strategy, every month in 10 to 20%, or based on
Okay.
If you have any insights, just let us know.
Sure, Andy, definitely.
Yeah, thank you.
Sure. Any other questions? Are we good?
I think somebody's asking, like, can you see if it can be possible to create a pooled subscriptions for all Atmiya members to website that Rama garu suggested? So I think Ram garu is going to reply to that. And
there is one question, and is fair value and intrinsic value the same?
Yeah, like one and the same, and fair value or intrinsic value. So I know, like, Guru Focus calls it as fair value, and we call it as intrinsic value, but whatever the components they are taking to calculate the fair value is also the same. So that's where, like, it's just the terminology, but it's one and the same. Yeah.
Oh yeah. So the next question is how to stay away from pump and dump stocks, like how to identify them like AMC stock.
So not even look at them only.
Yeah.
So basically, I mean, see, those are all like gambling, and just investing, trading is two separate things, right? So for investing, there is a clear-cut methodology and a formula. That's where, like, the difference between, like, I don't know, like, any traders we know of, like Warren Buffett we talk about, or Peter Lynch, or Manish Pabrai, right? So we talk about these guys because they have proven again and again and again. So I'm just following that currently, but if you are technically skilled and know the technical analysis, you can still make money, but there, like, you need to spend time, and you need to be technically savvy, and you need to be emotionally strong, and a lot of things plays roles into that. But your time and effort, if it is really worth, you need to understand that, and you see how, like, how much money you're making end of the day, right? So after spending all that money, right? So that is the key. But yeah, if you're really turning out to be good, then yeah, still tradable, but I won't really suggest to trade AMC's kind of stocks, and if you want to save your portfolio.
So somebody's asking, Sai Geeta garu asking about Bitcoin investment, and is it a?
I'm sorry, I'm the wrong person, Andy. I zero knowledge. I've never touched Bitcoin till today, so I'm sorry for that. Yeah, I don't know the answer for that.
So that's all we have in the chat.
Okay,
Andy.
great. And
So if you have anybody has any questions, so they want to ask verbally, we can entertain 1 or 2 questions, Andy, and then we can take the rest of them via Discord. Before we conclude, right, please, we're going to send a feedback form. We really appreciate if we can fill it so that we know what session to conduct in the future.
Rama garu, excellent session, Andy. Thank you so much.
Thank you, Venkat garu. Thanks, Andy. Thank you, everyone.
Thank you, everyone.
Have a
and,
wonderful Sunday.
Thank you,
Rama
Rama
garu,
garu.
thanks. Great
Thanks.
session, Andy.
Thanks, Andy.
Yeah.
Suresh garu, thank you. And thanks everybody for joining. And please, everybody, try to post your questions, your opinions, ideas, anything that you want to share. You may know, some things that we don't. So please try to educate everybody, and please, participate on Discord. And that is the place where we exchange all these ideas. And thanks again. Thanks, Rama garu. Great session, Andy.
Yeah, thank you, Ram garu. Thanks, Andy. Thank you, everyone.
Thank you.
Thanks. Bye.